What's up everybody? Welcome to the Stocks channel. My name is Cory, and Friday in the stock market we see a continuation of the rejection from the bear market resistance trendline, and we're coming into a very critical week of data next week with CPI data and FOMC. So first up, let's take a look at the S&P 500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Alright. So last week I made a video called Is the S&P 500 at a peak? And this week we saw a perfect pivot from that resistance trendline. So if you ask me, that deserves you smashing that like button on this video right now and help this video reach 2,000 likes. Alright, so we're starting on the weekly chart of the SPY ETF because this is telling us the big picture is that we're currently getting a weekly chart rejection from the bear market resistance trendline. So looking at this chart, it is very clear that if you're still bullish, you need to go take a nice cold shower because there is no reason looking at this chart that you should be taking on too much risk to the long side. Every time we've rejected from this resistance trendline in the past, we've seen at least 3 weeks of selling in a row. And this is the exact moment in time where we could continue to see more follow through with the selling going in through FOMC. So we have CPI data on Tuesday and then FOMC on Wednesday. So it is going to be an extremely volatile week ahead. And yes, there is still the possibility the bulls get the breakout. But if you're wanting to get bullish, just wait for the price action to prove it and wait for the confirmation of the breakout. Right now, all odds are in the bears' favor, and this is still a bear market. So do not expect the price action to get a bull breakout, but do not rule it out. And of course, if we see it happening, we will instantly get a lot more bullish. But right now, that is just not the path that makes the most sense. And the path of least resistance is still going to be lower over the coming weeks. And then maybe we'll get a bounce once we get down there towards that 200 weekly simple moving average. So bigger picture, we are still looking at a bear market heading lower. And we are not going to assume a bull market scenario. We are going to wait for the price action to prove it. So jumping over to the daily chart, we can see that clear rejection, and we're still at this very critical support, which I consider a bounce or die support level for the bulls, which is right there at SPY 393. If we lose 393, I think we're going to slice right through 390, even though it is a valid support level. And I think the bears will have no trouble filling the gap at 381. You can see the Bollinger Bands are squeezed on the daily chart, and just as of Friday, they're starting to open up. And that is going to allow the bears to flush the market to the downside as those Bollinger Bands start to expand. Anytime you get contraction, the market usually is followed up with expansion and volatility, and the market has gone absolutely nowhere for a full month. If you just draw a horizontal line back through November 10th, you can see the market is still sitting at that exact same price point. That means the next breakout is going to be a huge move in the market, and you're going to know with the confirmation in the price action that it's a bearish move if we break below 393 and a bullish move if SPY breaks out above 408. So above 408, you're looking full bull for the rest of the year, and below 393, you are expecting the market to continue to crash down because we're very likely going to see high volume selling if we lose these support zones. The other thing I want you to pay attention to at the bottom of the screen is that we did see increased volume on the selling. So this could just be day one of what could be high volume selling right around the corner. So I'm not trying to scare you. I'm trying to make sure you understand the gravity of the situation the market is in, because if we lose support, we are very likely going to see a very quick trip lower because the bears always take the elevator down. The elevator down in this scenario could be much lower. So just make sure you're aware of that and make sure you are prepared for the worst, because it's always better to be prepared and then not have to act on your plan, but at least you had a plan in the event we lose support. Again, the bulls need to break through all of this resistance or the bears are still in full control, with the resistance at 399 to 400 and this negatively sloping 200 daily moving average at 403. Above 403, we have critical resistance at 406 because this is a negatively sloping resistance trend line. So give all of the benefit of the doubt to the bears until the bulls prove otherwise, and you will do just fine in this market. And do expect December to be a very volatile month. On the NASDAQ 100 triple Qs, we were down 0.64%, and we see the triple Qs also at bounce or die support, which is going to be the zone around 280. Below 280, this is a confirmed double top from the rejection at 293, and there is no way a double top rejection at the bear market resistance can be anything other than extremely bearish. So triple Qs below 280 is open season for the bears to flush the triple Qs down to the gap fill at 268 and more than likely retest the yearly lows at 260. We could keep going lower than that, so all of the risk is still to the downside while we're below resistance. And you can see the triple Qs did get rejected below the 20 simple moving average for the 4th day in a row. This is a clear shift in momentum where the bears have now driven price below the 20 daily moving average, And even though we did have a short-term uptrend, it is very clearly starting to look like a double top rejection. So the bears are in full control and the bulls are on defense to hold this support at 280, and that is a bounce or die level before we go much lower. The bulls will need to break resistance at 288 and then 293, and if the bulls can get above 293, then we will be looking very bullish and we can instantly start getting bullish for the gap fill at 308. On the Dow Jones, we were down 0.91% on Friday, and we could see a clear rejection below the 20 daily moving average, and we did close at the low of the day on Friday, which is a very bearish candle, and we did break down below that support at 336. So it does look like we are going right towards the arrow price target at the gap fill at 331, and it looks like we should arrive right on time. That is easily going to be the price target to the downside, but the bears could push lower. So on a break below 331, we will be looking for 325. Now this is going to be strong resistance at 338 below that negatively sloping 20 daily moving average. So we could continue to go lower for the rest of the year. So do keep in mind the bears are still in full control. Critical resistance in the Dow will be 339, 342, and the gap fill at 347. On the Russell 2000 IWM ETF, we were down 1.23% on Friday, and the small caps are definitely leading the way lower with the confirmed double top breakdown when we lost the neckline at 182. We bounced back up to test the neckline as resistance, found sellers yet again, and closed the gap down here at 178, and we are well on our way to the double top price target at 176 and possibly even lower to 174. Below that support, we retest the yearly lows in the 160s. So again, the bears are in full control, and you're starting to see the Bollinger Band squeeze firing to the downside as those bands expand. So again, all of the risk in December is still to the downside, and the bears are still in full control until the bulls prove otherwise. Small caps bulls will need to break above 182 and 184, otherwise we're going to continue to see lower prices. On the ARKK ETF, we were down 1.45% on Friday with a clear rejection from all of the negatively sloping moving averages, and we're very likely going to see ARKK retesting 52-week lows at 32.5, and on a break below that, we're coming all the way down to $30. You're staying bearish in ARKK below 38 or the resistance at 36.5 because this is still a very powerful bear market that is likely not yet done going lower. On the VIX, we were up 2.42% on Friday as the VIX is now bouncing up from above the 20 simple moving average. So again, the VIX is gaining momentum and bullish energy to continue to push higher, and we're more than likely going to see the VIX pushing towards 24. Above 24, we'll likely see the VIX rising back up towards 30, and that is going to favor the bear market scenario that we continue to flush in the month of December. It's not until the VIX rolls over and dies, it comes back down below 20 once and for all, that we could get back into a bull market, and I just don't see a scenario where we're going back into a bull market just yet. On Bitcoin, we are currently up 0.23%, and Bitcoin is still holding above that 20 simple moving average, so it is possible that Bitcoin is looking a lot more bullish, but we won't know until we break resistance at 17,550, and then we could make a run up to 19,000. If we lose the 20 daily moving average, look for a retest of support at 16,000, because if we lose that support, we're going for the next leg lower at 14,395. On Amazon, we were down 1.39% on Friday, and we see we're still below all of the moving averages. We're still in the bear trend, and we're at risk of retesting the 52-week lows at 86, and if we lose that support, we're going for the next leg lower at 77. You could try to be a bull at 86, but if that level is lost, you instantly need to get risk off for the next leg lower, and if we get a strong bounce from 86, we will consider that it's a possibility of a double bottom. Strong resistance levels will be $90 and $97, and you can't get bullish until we break resistance. On Microsoft stock, we were down 0.8% on Friday, and we did close below the 20 daily moving average, but just above the 50 EMA, and we're still above support at 242. The all clear to short Microsoft will be the break below 242 for the gap fill at 228, but as long as we're above that support, the bulls could continue to push back up towards 252. Above 255 will be looking bullish for the gap fill at 265, but right now I still think the bears have the favor, with the bulls losing their support trendline, and that backtest of that trendline acting as resistance. On Nvidia stock, we were down 0.98% on Friday, and Nvidia is looking extremely bearish at these levels because we're testing the negatively sloping 200 daily moving average as resistance and the resistance trendline of the bear market. This is going to take a lot for the bulls to push through this resistance, and I don't expect them to win this battle. So at this point, I think we could start saying that Nvidia is very likely gonna get rejected and start heading down to close the gap at 142. We'll know we're wrong right away because we'll break above 175 and then we can bail on this idea. But right now, I do think Nvidia is heading much lower from these resistance levels. Look for downside support at 166, 163, and 156, with that critical upside resistance at 175 and 179. On Tesla stock, we were up 3.23% on Friday, but I want you all to listen to me very closely because I know this is a retail favorite stock. this stock is very likely heading much lower, and you need to be very careful. If you look at the trend, we're in a strong bear trend. We have this double top rejection from 197 that is going to confirm on the breakdown below 167, and we're very likely about to get rejected from the negatively sloping 20 daily moving average before we flush to the downside down towards 138. Now, whether or not this happens is to be determined, but I want you to expect this because we are in a bear trend and looking very weak, even after the bounce on Friday, which is more than likely just a lower high before we continue flushing to the downside. Now, I know this is a retail favorite, and I know a lot of you hate to hear that Tesla is going lower because you own a lot of it, but this is important that you understand that you're going to be able to buy it at much lower prices if we cannot break above 184. If we break above 184, then we could come back up to retest 197, but it's not until we break above 197 that we invalidate this double top, and then you can get a lot more bullish knowing that we invalidated the bearish pattern, and you know you have more confidence that Tesla is likely going higher and not lower. But right now, all of the risk looks like Tesla is heading much lower, and you'll know on the break below 167, so set your risk at that level. So for the time being, I'm extremely bearish on Tesla until we can get back over 197. So do keep in mind that we could be going much lower with downside support on the way to 138 at 155. On Apple stock, we were down 0.34% on Friday, and you could see a very bearish rejection on Apple from the negatively sloping 13 EMA, and we are still in this bear trend as long as Apple is below 146. We have the valid downside gap fills at 138 and 133 with possible support on the way there at 135. Now, if Apple can hold support at 141 and break all the way back above 149, then it will look like a bullish double bottom, but there's just no way we're going to expect that while we're in a downtrend below the bear market resistance trend line and strong resistance at 146. On the financials, we were down 0.26% as the financials are still getting rejected below a negatively sloping 5 EMA and very close to closing the gap at 34.35. The industrials were down 0.82%, losing support and very likely trending down to fill the gap at 97. The healthcare sector was down 1.28%, losing the 5 EMA as support, but overall still in a very strong bull trend unless this becomes a double top from 140 and a break below the neckline at 137. The energy sector was down 2.43%, slicing right through that support level at 84 and closing below the lower Bollinger Band now for 5 days in a row. This is extremely oversold and a warning sign that we could be heading into recession. So if we don't get a bounce soon, we're very likely heading down towards that 200 daily moving average, which is at $80. So jumping back over to the S&P 500, take my warnings very carefully that we are very likely heading into a very volatile December, and we could just be seeing the beginning of what could be a major sell-off. I'm not trying to scare you, I just want you to be prepared because a lot of these charts look like we are going much lower. We'll know instantly if we're wrong because we'll break out above resistance, and then we can instantly become more bullish because as traders we have the flexibility to know when we're wrong and then change our ideas instantly and then go to the other side of the trade. But right now I'm telling you it looks like it's bearish across the board, and it looks like the big tech companies still have a lot lower to go, and it looks like some of those other stocks in the Dow Jones are starting to roll over and die. I'm not typically a doom and gloom kind of person, but these charts are looking very bearish, so just be aware of that. Also, don't forget I have Bank Trade Alerts, which is an algorithm-driven trade alert service that only trades the ETFs TQQQ and SQQQ and sends you all of your buy and sell alerts directly via email and text message. You can learn more about Bank or learn how to subscribe by clicking on the link in the description of this video. If you're looking to become a better price action trader, consider joining us at the Stocks Channel Trading Discord community where you get access to all of my intraday updates and analysis. You can find out how to join the Stocks Channel Discord by clicking on the link in the description of this video. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.